Welcome back to Financial Illumination, your one-stop shop for all things personal finance and financial planning. My name is Sarah Moore. I'm a financial planner in our St Albans office, and I'm here with my colleague Chris Fisher, financial planner from our Kent office. Today we're going to be discussing common investor mistakes. So Chris, tell me, what is the most common investor mistake that they make?
So probably the most common mistake we see being made by investors is by trying to time the markets, and this applies particularly to self-investors. So people that try and invest when markets are going up and trying to sell correctly when markets are going down. When in reality, what we've seen historically is that by applying such methods, you could actually miss out on some of the best days, because some of the best days investing usually come straight after the worst days. And actually, if you look at previous studies, they will show that just by remaining invested over that period and looking at long-term gains, then that's the best approach to take.
Often make people nervous though, can't it? Holding fire.
Yeah, absolutely. And you know, that ties us into something else we're going to talk about psychology of investing.
Absolutely. And why do emotions play such a large role in investing mistakes?
Yeah, so and again, this is where psychology comes into it. So a lot of it comes down to emotional tendencies. And it's something that's completely normal when it comes to investing. Some people have emotional ties to some investments, you know, whether they've had them for years and years and years and get attached to them, or whether they've inherited some shares and don't want to let go of them. But again, this can have a knock-on effect with investment returns, especially over the long term. And by holding on to those investments, you can really miss out on some of the good days and bad days. So it's about finding that fine line between removing yourself from making any emotional decisions whilst making sure that the investments are more tailored to your financial objectives. And in the words of the great man himself, Warren Buffett, it's about being fearful when others are being greedy, and about being greedy when others are being fearful. And that's something that I think is a great takeaway point.
And in terms of social media, obviously a lot of people are looking at that for sort of advice. How dangerous would you say it can be following investment trends that you've seen on social media?
I think social media is great for, you know, informational purposes, having the resources available at your fingertips to learn more about what products are available, what trends are out there, and all those sorts of things. But at the same time, it can be dangerous. Comes with some risk when it comes to investing. You know, you see influencers and people that you might look up to advertising these stocks or cryptocurrencies and all those good things. But the danger is that you don't fully understand what you're investing in. Therefore, it's very important to make sure you do your own research, you understand what you're investing, you understand what the risks are, and making an informed decision about whether you should invest in that or not.
And I guess there's also the thing to think about is, are things genuine?
Yes.
You might see on there.
Yeah, absolutely. You know, you read some horror stories now about people getting scammed. And therefore it's always best to do as much research as you can around the topic.
So in terms of diversification, what would you say are the main risks of not diversifying your portfolio?
Diversification is a great way of smoothing returns over long term. It's about not having too much onus in terms of what stocks you pick, what geographical locations you invest in, what sectors you invest in. And yeah, by having a well-diversified portfolio, as I said before, it just helps smooth the returns, and it reduces the exposure to unnecessary risks, and you know, puts more of an onus in risk that you can actually control.
And then another sort of area that is commonly talked about is fees. Why do you think investors often underestimate the impact of fees?
Yeah, so fees is a bit of a red herring, because a lot of people don't really evaluate the impact of fees when it comes to investing. They choose their investments, they stick with them, and they don't actually look at the effect that that's having and the compounding effect that fees are having on their portfolio as a whole.
Do you find often people are unaware of what they're actually paying?
I would say so. I would say so. You know, the amount of checks that we do on people's portfolios and actually put together a consolidated version of their fees, and you know, a lot of people are like, wow, is that really what I was paying?
And often I think where people have got, they'll look at their plan and think that they're paying lower fees, but they're not receiving the advice and getting the value for money.
Yeah, absolutely. And I think the cheapest option isn't always the best option. I think it's just about having that understanding what you're paying for and being able to put yourself in the position to be able to weigh up, is that worthwhile, and am I getting value for my money? I think that's in effect what it's about.
And the transparency is important as well, isn't it? So everything that people are paying for is clearly explained to them.
Yeah, absolutely. And again, unfortunately, in the sector, you'll find that transparency hasn't always been there. It's something that the regulators are trying to bring out a lot more with financial firms. But yeah, if I would always advise people to reach out to someone to have a review of what they're invested in if they want to understand more about what fees they're paying.
So is doing nothing sometimes the best investment strategy?
I think so. There's definitely an argument for that. So sometimes there is a temptation to react to what you hear in the news and what's happening in the economy. And again, it comes down to emotions, and people want to take more of a defensive stance when things like that happen. But I think it's always important to try and ride the wave and try and take out that temptation rather than making emotional decisions.
Because people often will hear something on the news or in the media and immediately react to it.
Yeah, absolutely. And unfortunately, that has become part of modern society now.
Yeah. So in terms of reacting to what people have heard in the news and on the media, would you say the impact of what happened in the Middle East earlier in this year would have caused people to react?
Yeah, absolutely, and I think that's a classic example. You hear all the doom and gloom in the news, and it is very tempting to react to it. Yes, you would have seen some market corrections made within the markets, but we've seen it all before. We've seen it with COVID, we've seen it with the Liz Truss era, and what happened there. But you do see things recover, and I think it's about holding strong and make sure you're not making any emotional decisions as a result of it.
And I think people that have been invested for some time and have seen how this will pan out are the ones that would understand that the best thing to do is to do nothing.
Yeah, absolutely. And I think a matter of it as well is looking at what your personal situation is. And if you're not gonna need to access your investments for years and years and years, then it is about looking at the bigger picture and seeing, okay, do I need to make an irrational decision, or can I ride the wave and let long-term returns do what they need to do?
And in terms of experienced investors, what mistakes do you think they often would make?
Yeah, so again, this is something that we see quite frequently, again, with experienced investors, but mainly with self-investors as well. It's about the psychology, and we see it frequently where experienced investors really believe in what they're invested in, and it doesn't matter what performance is like or what the investment returns have been like. They will stand by their posts no matter what, and if anything, they might actually put more money in when in fact they should be considering taking some money out. So I think when it comes to investing, it's about trying to take the emotion out of it and just having that partial point of view and make sure that you are making the right investment decisions based on your attitude to risk and what your financial objectives are.
And so with that in mind, if there's one thing you would tell listeners to take away with them today, what would that be?
I think the main thing I would take away from today is it's about trying to control the controllables. So that obviously there's things outside of your control, such as economic conditions, change to legislation, market movement, even economic cycles. But there's a lot of things that you do have control and things that you can control, such as investment costs is a big thing. So reviewing your portfolio, checking that everything you're paying for, you're happy to pay that and it's worthwhile paying for. Looking at your savings rates and what returns you're getting out of cash. Looking at diversification, but also things like your exposure to risk as well. And also almost having a look in the mirror and looking at whether you are adopting those common investment behaviours and seeing whether there's anything you should be doing to stop you from making those emotional decisions. Because in effect, long-term success isn't about finding the next winning stock. It's about making sure that you've got a healthy relationship with investing and you are investing over the long term rather than making those short-term decisions.
Thanks, Chris, and thank you for listening. As always, anything discussed today does not constitute financial advice. If you would like to arrange a meeting, please go to our website, luminwealth.co.uk.